Here's something nobody in the Singapore property or investing space will tell you openly. Most of the advice you receive from agents, from banks, from financial planners, from property portals, from YouTube channels is shaped by someone else's agenda before it reaches you. Not necessarily because they're dishonest, but because every business model has an incentive structure, and that incentive structure determines what gets said, what gets emphasized, and what gets left out. Today, we're going to give you the 4 foundational principles that should sit underneath every investment decision you ever make, in property, in equities, in anything. Get these right, and you'll make better decisions than most people in Singapore who have been investing for decades. This channel covers Singapore property and macro investing without an agenda. No developer affiliations, no commission, just the analysis. If that's useful to you, subscribe. Let's get into it. No one cares about your money more than you do. The first principle sounds obvious. It isn't. Most people outsource their financial decisions. They follow what their agent recommends. They buy what their banker structures. They invest in what their friend made money on last year. And they do this not because they're lazy, but because investing feels complicated and experts feel authoritative. But here's the structural problem. No financial professional, no matter how good, no matter how ethical, has your full picture. They don't know your real risk tolerance. They don't know how you'll feel watching your property sit on the market for 8 months with no offers. They don't know what keeps you awake at 2 a.m. They don't know your career trajectory, your family plans, your contingency reserves, or your emotional relationship with money. You do, or you should. So before you engage any professional, before you look at any product, the work starts with yourself. Ask 3 questions. First, what is my actual risk tolerance? Not the one I'd like to have, but the one I'd demonstrate under real stress. Second, what is my investment horizon genuinely, not optimistically? And third, what would a bad outcome actually cost me? Not in dollars, but in life terms. If you can't answer those 3 questions clearly, you are not ready to invest. You're ready to speculate. And in Singapore's property market, speculation with leverage is one of the most dangerous financial positions a household can be in. Understand their agenda before you take their advice. The second principle is not about cynicism. It's about clarity. Every professional you engage in the investment process has a business model. That business model determines what advice is in their interest to give you. This isn't a criticism, it's just how economic systems work. The question is whether you understand it before you sit across the table from them. Property agents in Singapore are paid on commission, typically 1 to 2% of the transaction value. That means they are paid when you transact, not when you make money. A good agent will still give you honest advice, but structurally, the advice that earns them a commission is always going to feel more compelling than the advice that tells you to wait. Banks and mortgage brokers are paid on loan origination and spread. Their product is debt. The more you borrow, the better their margin. This doesn't make them unethical, but it means you should never treat a bank's maximum loan quantum as a recommendation. Financial advisors operating on commission-based models earn when you buy the products they recommend, Fee-only advisors, who charge a flat fee regardless of what you buy, are structurally more aligned with your interest. Know the difference before you engage one. Property portals and media are paid by developers and agencies for advertising. The editorial content and the sponsored content often sit uncomfortably close together. Read accordingly. None of this means you can't use these professionals. You absolutely should. A good agent is invaluable. A sharp mortgage broker saves you real money. The point is, understand the architecture of their incentives so you can weight their advice correctly. The past doesn't repeat, but it rhymes. Study it anyway. The third principle is about historical literacy. Most retail investors in Singapore make decisions based on what has happened in the last 2 to 3 years. That's the window of experience that feels real and immediate. But property cycles in Singapore run 7 to 12 years. Equity market cycles run longer. If you're only reading the recent past, you're reading one chapter of a much longer story, and you're probably misreading it. Look at what happened to Singapore property buyers who entered in 2007, right before the global financial crisis. Prices fell 15 to 20% in 12 months. Then look at what happened to buyers who held through 2009 and sold in 2013. They made some of the strongest returns in Singapore property history. The event was the same. The outcome depended entirely on entry point, holding power, and time horizon. Look at the cooling measure cycles. Every major ABSD increase has been followed by a period of transaction volume suppression and then a gradual resumption. The market absorbed the 2023 ABSD hike faster than most analysts predicted because underlying demand from locals was structurally intact. When you study past transactions, not just price movements, but the economic conditions, the interest rate environment, the policy context, you start to develop a feel for where in the cycle you are. Not perfectly, never perfectly, but better than someone who is only reading the last 18 months of property headlines. Before you buy anything, spend time in the URA transaction database. Look at what the unit you're considering last transacted at and when. Look at what comparable units sold for during the last downturn. That tells you more about real value than any developer marketing deck. Know the cycle. Know which products fit where in it. The fourth principle ties everything together. Every asset class moves in cycles. Property cycles, equity cycles, credit cycles. And within each cycle, different products perform differently, depending on where you enter. In Singapore property, the cycle has distinct phases. In an early expansion phase, when rates are falling, policy is neutral, and transaction volumes are recovering, mass market and OCR properties tend to lead the recovery. They're more liquid, more affordably priced, and attract the broadest buyer base. In a late expansion phase, when prices have already run significantly and sentiment is euphoric, CCR and prime district properties often see the strongest price action as wealth effect and foreign interest pick up. But entry risk is highest here. In a contraction phase, when rates are elevated, cooling measures are fresh, and transaction volumes are suppressed. Freehold resale in established districts tends to hold value better than leasehold new launches because the buyer base is stickier and less leveraged. The same logic applies in equities. Growth stocks outperform in low-rate environments. Value and dividend plays defend better in high-rate environments. Knowing which phase you're in doesn't guarantee outcomes, but it tells you which products are structurally better positioned for your expectations. The question to ask before any investment is not just, is this a good asset? It's, is this a good asset at this point in this cycle for my horizon, at my risk tolerance? That's the complete question. These 4 principles don't change. The market changes, the products change, the cycle changes, but the framework underneath every good investment decision stays the same. Know yourself, understand who you're dealing with, study the historical record, and map your decision to the cycle you're actually in. In the next video, we go from framework to forensics. We're going to take a real HDB upgrader scenario, actual numbers, actual loan quantum, actual CPF position, and run it through these 4 filters to show you exactly what the decision looks like in practice. Subscribe so you don't miss it. And if these 4 principles resonated, share this with someone who's currently in the middle of a property or investment decision. It might save them a very expensive mistake.